special guest joining us in just a couple moments here. I'm just looking at the bottom of my computer screen. He might chime in to help us answer some questions or help me answer your great questions. I appreciate you all for being here. Before we get started, I want to remind everybody about Rebel Capitalist Pro. That is the investment product, the online forum I have with my two amazing partners, Lynn Alden and Chris McIntosh, where we've got their back-end research from Chris and Lynn, and we do live streams just like this where we answer member questions a couple times. Well, sometimes we do it 2 times per week, sometimes once a week, depending on how much research is coming out from Lynn and Chris. But definitely check it out as soon as we get off the live stream. You can find the page at georgegammon.com/pro. But let's dive right into today's questions. That's why you are all here. So we'll go to the top of the chat. And guys, please remember, if you've got a question, put in question in capital letters so I can see it, because a lot of times the chats go really quickly, and that's the only way I can keep track of it, unfortunately. Okay, first question. LBE retiree, I understand the function gold plays in a portfolio, but do you ever see the day when gold, silver become the main portion of your portfolio? No, no, I don't see a day where anything becomes the main portion of my portfolio, because I like to be diversified. I mean, within the 80% of my investments, how I define that, is something that has to pay me to own it. Maybe I could see a time when a majority of that was real estate, just because that's my area of expertise. But as far as a day when I've got 80, no, especially not now, because the only time when I would consider increasing a position in silver would be if it was super cheap. And although it's cheap now relative to the monetary base, if you look at a historic chart adjusted for inflation, it's still not at all-time lows. And also, too, silver isn't at one of those places where if you tell people you might be buying it, they're going to tell you you're completely insane. And such as uranium, that would be an example, or coal would be another example of that. You're buying coal? What? Is that even a thing anymore? You know, what are you doing? You're investing in the 1800s? That's a good play. When you get people that are making fun of you and criticizing you for an investment, that's when I get more excited about it. So I don't know that silver would fall into that category right now. Doesn't mean I'm not bullish. It just means that it's a speculation for me, and that's 10% of my portfolio. And that doesn't mean that silver is all 10%, because in there, Bitcoin, uranium, the miners, I'm trying to think what else I have in my portfolio, but there's some variety and diversification. So the short answer is no, I would not consider that. Okay, Merrick asks if there will be hyperinflation, we can thrive by buying gold and silver. But if it will be a great depression, how do we thrive? Well, gold can do well in a lot of different situations, but you've got to keep in mind that just because we get hyperinflation, it doesn't necessarily mean that you get rich by owning gold and silver. Because if gold and silver just go up in nominal terms, and you've got to sell your gold and silver at some point, then you're going to have to take a capital gain, and then you're going to lose purchasing power. Because let's just say that you buy gold at $1,000 an ounce, and it goes up to 10,000, but you didn't increase your purchasing power because it just went up with the rate of inflation. Whether that's hyperinflation, inflation, however fast it gets there. And then you've got to sell the gold. Well, you've got to pay, let's say, a 20 or 30% capital gain on that. And that takes you down to 7,000. So now your purchasing power is less than when you purchased it at 1,000, even though nominally it went up from 1,000 to 10,000. And so I know a lot of people say, oh, the way around that is gold coins. Do some homework, guys. I don't think so. The experts I talk to, yes, it's true that gold coins aren't reportable If you sell them, you're an American, it's different for different countries, of course. And I think it might even be different state to state. But just because it's not reportable when you sell it, meaning that the pawn shop or the gold buyer, the gold dealer, doesn't have to report it or fill out some additional form, it doesn't mean that you don't have to report that capital gain on your 1040. That's a whole different question. I think people kind of get confused there. So make sure you're doing your homework when it comes to the accounting. And don't just think that because you have gold coins, that means you never have to worry about capital gains. Okay, we've got a lot of gold questions here. I'm going to maybe try to get some diversity. I'll go over one more because it looks like Zach listened to the podcast I did with my good buddy Chris Irons, who has the Quote the Raven podcast. If you guys haven't checked out that episode, make sure you do so today. It would be a good use of your time. Very good content. I think we went for probably an hour and a half or an hour and 40 minutes. And Chris is always great. So check that out. But your question specifically is, what's your end game for gold? What thesis might play out where you would take profit on physical gold? I don't know if there is an end game where I'd sell gold, because I don't buy it to make money. It may sound weird, but that's not why I buy gold. I just buy it to protect my purchasing power. So as long as it's protecting my purchasing power, yeah, I don't know that there would be a situation. I'd have to think that through. I think I got that question on last week's live stream, but I don't know. I'd have to think it through. All right, let me go ahead and bring in our special guest right here, Mr. Hugh Hendry. Hendry, welcome, or Hugh, Mr. Hendry, welcome to the live stream, buddy.
Hi there. Hi. I'm going to change my position a bit.
Oh, take your time. Take your time. I'll just move on with these questions. Let me know when you're ready to chime in.
Yeah, and George, that was nonsense. You can't think of a situation where you would sell gold. I mean, really? That's absolute nonsense. Gold was 2000. Was what? 1650 in 2012, and you were quite happy to sit there for 8 years and for it to be like such a shitty investment. I mean, you've got to take the emotion out of these things. Gold is just another commodity that
but you got to ask yourself why you're owning it. See, you're looking at it from a professional money manager position, to where you've got you got a P&L, and your job is to increase the value of the assets under management. But for me, that's not my objective with gold. Let me be clear there. So I don't look at it as I'm going to go into gold because I think it's going to appreciate in value, and therefore sometime down the line I can sell, take my profit, and parlay that into something that I think is a better investment at the time. It's just not the way I look at gold. So I look at car insurance.
I'm not managing a professional portfolio. I've been involved with gold investments for the best part of 20 years. And when I hear people say they would never sell gold, you're usually getting kind of close to an intermediate top. Gold. Yeah,
but if it goes down, I don't care. If it halves,
you care. You absolutely do care. That's nonsense. No, I don't. If you buy it at 2,000 and it goes to 500, you kind of care. You feel like an idiot.
No, I don't.
Especially if the stock market kind of goes like doubles or triples. If you think of the experience from 1979 until 2002, my God, that's a lot. That's almost a generation of being wrong. So gold is simply a speculation for everyone. And presently, it is a rewarding speculation. And I think the prognosis for the immediate future is that it will continue to be a very rewarding investment. And therefore, really one's biggest concern is that it's volatile, and it's going to have these kind of horrible days, which are going to kind of feel like a kind of a punch in the stomach. But, the prognosis just now is good. But, at some point in the future, it will have to be sold, I would say.
Yeah, it's I don't know that the problem is with my view of gold or my view of how I look at an investment strategy, because I look at it in terms of a set of rules that I try to abide by. And even though I'm going to have losers, as long as I maintain that set of rules, then over the long term, I'm going to come out ahead. And just one of my rules that I have in my own head. Now, this doesn't mean that my rules are correct. They're wrong. But that's the way I try to set up a portfolio. It just goes back to my days of playing blackjack, because you could say that you have to look at every single bet as a probability play. And I in my own head, and again, this could be wildly wrong, if I divide my portfolio into 10% gold and just keep it, don't sell it, just buy it, and then 80% that pays me to own it, those would be investments, and then 10% of the portfolio just as speculation, where I'm trying to get asymmetry, like silver or the gold miners right now. If I do that and don't worry about the result, in my own mind over the long run, I'll be further ahead, because I'm trying to eliminate the emotional component out of the equation, because I know myself well enough to know that there's no way I could time gold. There's just, I can't time anything. The only thing I can do is just live by those set of rules. And then within the investment component and the speculation component, just trying to buy stuff when it's cheap and sell it when it's expensive, and make sure you're getting positive cash flow that should be stable long term. And that's the only edge I have, if that's even an edge. And it might not be, but it's done well for me since 2012, and who knows, maybe it won't do well in the future. But I got to stick by my gun.
Keep on trucking. Keep on trucking.
Yeah. So maybe it doesn't make sense, but fortunately, I'm only doing it with 10% of my portfolio. So
yeah, but remember, you say 10%, but if you're including gold mining shares in that 10%, then you're talking about
the speculative side.
That's your speculative. Okay.
Yeah. Now those I would sell. Yeah, those I would sell. Yeah.
So you're describing you're describing almost a permanent portfolio, that you have a representation. You have a kind of permanent representation in some different asset classes, and then you've got this kind of speculative bucket where you play blackjack with the odds.
And the bulk of it is something as I'm owning things that are paying me to own them. So such as real estate, cash flowing real estate. So even if I'm wrong, if it cash flows the day I buy it, if it makes sense the day I buy it, it doesn't have to appreciate. I don't have to increase rents. It's not based on a pro forma. It's the day I buy it, it's positive, and it's paying me with 10, 12%. Even if I'm wrong, that's my downside right there. And that I'm happy with that, especially if it's 80% of my portfolio.
Okay. Let's hear these questions. I'm going to get some headphones, but let's hear the questions.
Okay. All right, guys, let me keep going down here. Okay, so AV asks a question that's a little, we're getting off the gold topic. So we'll get some diversity within the questions. To what do you attribute sudden spike in treasury rates over the past week and in early June? I don't know if I'd have a good answer there other than noise. I mean, markets go up and down, and I don't know that you can look at something prices over a week and say, okay, it's doing it because of this, when there's so many cross currents, especially in the treasury market right now, with as much of the debt and those assets are going on to the Fed's balance sheet. And if you talk to Jeff Snyder, he would argue that the increase in demand from the Fed, taking their balance sheet from 4 trillion to over 7 trillion over just the span of a couple months, really didn't have any effect on the price of treasuries, because there would have been other buyers out there. I don't know. I don't know. Jeff's a hell of a lot smarter than I am. But I think that the main thing there is you've got such a massive market, and to put your finger on a reason why interest rates are going up or down or prices are going up or down, I think it's just impossible. I think you might be able to look at long-term trends, but I don't know. What do you think, Hugh? I don't know if you heard the question, but they said, what do you attribute the sudden spike in treasury rates over the past week?
So the question sounds like a headline to a Bloomberg article. You know, every day I have a web subscription to the Bloomberg News, and it was like, you know, treasuries crash.
Yeah.
And then you look at the prices, and they've moved like nothing. You know, they moved like less than 1%. Like, wow, you know. So there's a lot of hyperbole in the description because it sells subscriptions, and you're quite right. You're talking about a thumbnail. The length of time is impossibly short to derive conclusions, and I suspect that because gold is the flavor of today and tomorrow and yesterday, but with gold having its move, with the dollar having weakened at the same time, there's a lot of people that kind of want to say, aha, and with the Fed printing money, this now is the first real concrete signs that we're going to have inflation. And so they want to then impose that, not ideology, but that kind of intellectual posturing and say, that's why treasuries are now selling off, treasuries are going to crash. And so people, it's a febrile, imaginative environment, and people would like, with gold moving as it is, it makes a lot of sense to some people to imagine that treasuries have now peaked and treasuries are assets of confiscation.
Right.
I'm not sure. I think the move that gold is having is very, very consistent with treasuries going higher again, because we have to reflect on gold has many different qualities that people are willing to pay up for in these circumstances, and one of them is kind of liquidity, security, the whole way that you described it. And in a deflationary environment, it has just as much appeal as the inflationary environment of the 1970s. So anyway, to cut to the chase, I would ignore 1 to 2 week kind of spikes, and spikes tend to be the wrong words to describe these moves.
Yeah. Okay. I think that's great. Hey, Rob asks, I currently have 2 investment properties with lots of equity. Congratulations, Rob. I will be selling this year. Capital gains will be a killer. Yeah. Any advice on how I can reduce cap gains? I don't know of any way to do that other than just a 1031 exchange, Rob. And I'm assuming you've thought about that. I don't know if you're trying to get out of the real estate to protect your equity, in which case a 1031 might not make sense. Although if you're in a cyclical market, you might take a 1031 to move into a more linear market. That would it wouldn't eliminate your downside with your equity, but it might reduce it. And so that would be the best piece of advice I can give you, assuming you're an American. Okay, Emilio. Oh, okay, this is about Medellin. So George, could you indicate to me a good real estate agency and good property manager in Medellin? I would like to invest in small rental for the first time in my life. Okay, well, congratulations, first of all. You need to be very, very careful, Amelia. I'm glad you asked. And I would look up my architect and designer, Angie and Joaquin. And their website is, let's see, it's Oreo, but it's tough to spell. I can never spell it right. If you email my assistant Adriana at contact@georgegammon.com and just ask her for Angie and Joaquin's WhatsApp, and then you can WhatsApp them, and they can guide you in the right direction, either finding a property or finding a good real estate agency to work with. And then Angie manages properties as well. So I use her. So I'd suggest anyone that's thinking about it, use her as well. She's like a kid sister to me. I've known her and Joaquin since 2013. And I mean, they're like family. So I can't recommend them enough. Okay, question. Considering a euro crisis, what do you think will happen to current countries like Poland and Hungary that have their own currencies and central banks, but gravitate towards the euro economy? Oh, Hugh, what do you think of that? You probably have a lot better insight on that than I would. Did you hear that question? No. Hey, Hugh, can you? All right, Hugh, can you hear me, buddy? Hugh, I don't think your audio is there. Yeah, I can. Okay. All right. Well, I'll go ahead and try to tackle that one while Hugh's dealing with some tech issues there. Okay. Considering a euro crisis, what do you think will happen to countries like Poland and Hungary that have their own currency central banks but gravitate? I think they'll be in a better position. I don't know that they would be completely isolated because their economies are so dependent upon the entire Eurozone. But I think that I would prefer, if I had to be somewhere in that area, as far as investments, I would much prefer to be in an area like Poland or Hungary. And also, too, I like some of the southeastern places. I know Andrew Henderson's talked a lot about Georgia, Armenia, and I like Croatia a lot. I love Montenegro. And as far as places to spend time, but I'd also start looking at those areas for investment opportunities. And one of the things that Chris talks about a lot is a flight of capital from the West. And I'm not saying it's all moving out, but maybe some capital is considering moving to areas where the trajectory isn't so hostile towards capital. Let me just put it that way. I think most of you know what I'm talking about. So could that benefit the Asian area? Could it benefit Eastern Europe? I think possibly. It's definitely something to think through. So I think bottom line is I would like those countries better, but I don't know that they're completely isolated because everything there is so interconnected. Okay, let's see if we can get Hugh back on the line. All right, Hugh, how's your audio now? Can you hear me? Yeah, the audio is not working. Now the audio is not working. All right, guys, bear with us one moment here. Let me okay. Maybe I'm at Hugh's place right now. So I'm in one of his guest rooms. So he's just right up there in the master. Maybe he'll walk down here and I'll tell him the audio. And by the way, before I forget, I'm at Hugh's place. I don't know if you guys can see the view out there. I'd love to show you guys the view from Hugh's. Oh, it's too bright. You can't see it. But right behind me where all the light is coming in, that you can see the ocean. It's just right there. And he's got this this really cool infinity pool that looks out over the ocean. I wish I could show you, but anyway, let me focus on the questions here. Question, what is in the end wrong with Japanification? Stocks, real estate flat, but people employed, currency exists, pension system still works after 20 plus years since the bubble, life goes on. Well, so that's a pretty extensive question, and it's a good question. I think for the United States, that would be, if you just have a 20-year time horizon, that might be a pretty good option. And in fact, that I think a lot of people would argue that would be a best case scenario. Problem with that is you're assuming that Japan will never collapse and it will just be in this kind of malaise forever. And I think that would be a bad assumption. you have to understand that when you're increasing the amount of debt, and I've talked about this on a few different podcasts that I've done this past week, and it's based on Lacey Hunt's interview with Grant Williams and Bill Fleckenstein on the Endgame podcast. That's Grant and Bill's new podcast. This was episode 6. And I think Dr. Hunt articulated it beautifully, and that it's not really about servicing the debt. And it's not about a debt jubilee. Let's say that the BOJ could buy 100% of the JGBs, and so they own all the debt. So all you're looking at is just X number on the asset side of the central bank's balance sheet, and X number, the same number, would be on the liability side of the government's balance sheet. And then you just reset it. It's just like the MMT people would say, it's just like an NBA scoreboard or a basketball scoreboard where it's at 100 points or $100 trillion in debt, let's say, and you just boop, hit a button and you go right back to zero and you start over. And so that's kind of the assumption that a lot of people have, that, well, the problem with the debt is servicing the debt. And I think Dr. Hunt would argue, and I completely agree with this, it's not really about servicing the debt. That is a problem for sure, but that's not the biggest problem. The biggest problem is how distorted the economy became as a result of all the government spending that it took to create the debt in the first place, because of all the misallocation of resources, because of all the malinvestment, because the moral hazard that was created. So as an example, we go back to Japan and look at all the zombie corporations that they're well known for right now. If their debt went down to zero, it's not like those zombie corporations go away. The structure of their economy has been built over the last 20, 30 years of this increasingly high government spending. Let's look at the United States. Prior to COVID, the government spending was almost 50% of GDP. So now it would be much higher than 50% of GDP. Well, if we could just wipe out the 26 trillion in debt, say the Fed bought it all, and it just poof, it's gone, and now all of a sudden we're at 0% debt to GDP. Does that mean the government is now a lesser component of overall economic output? No, they're still at 50%. So does that mean that our economy would just boom and we'd be off to the races? And maybe temporarily if government spent a lot of the money into existence, but all they do by spending the additional money is distort the economy even further. You see? So there's no quick fix. There's no easy way out. At some point in time, if you've overconsumed as an individual or as a society, you are going to have to underconsume by the same amount, if not more, to get back to a point of equilibrium. That's the bottom line. So I think you ask a great question, but there's no easy answer to a very complex question. And and even what I'm saying right here is really kind of oversimplifying it. But I think bottom line is exactly what I said. And Japan right now, if the U.S. had the next 20 years like Japan their last 20 years, I think that'd be pretty darn good. If you could just choose that right now and reduce the rest of the downside, I think that would be a prudent decision. Now, whether it plays out like that or not, I don't know. Japan is so different from the United States in the standpoint, first and foremost, of their savings rate. Secondly, because they are a net exporter, so they don't have deficits; they have surpluses. So that means more market demand for their currency. Where, from the United States standpoint, ignoring the fact that the U.S. dollar is a reserve currency, which obviously is huge. But if it wasn't, then every single year you would have less and less demand for these dollars, because of the trade deficits, and Japan has that surplus. So those are the two big differences. It's not an apples to apples comparison, but I think that's pretty much what I want to say on that. Let's see if let's get Hugh back in here. All right, Hugh, how's the audio now?
You tell me.
Yeah, I can hear you, and I think you can hear me. So
yeah, I can hear you well. Just the microphone keeps coming and going. So apologies, everyone.
No problem. No problem. Okay, so if you have a large position in cash, is now the time to consider buying high, especially with a potential digital dollar on the way to fuel future inflation? Hugh, what do you think? If you got a big cash position right now, what do you do to protect it if you're worried about inflation?
Was the presumption that you buy high? Anyway, so you have a large cash position. So
I think he's talking about the stock market, because the stock market, the valuations are extremely high. But he's saying,
okay.
should he buy anyway, because he's more worried about losing purchasing power with the cash that's in the bank, and theoretically stocks might be a bit of a hedge against the inflation.
Yeah, well, this cuts to the matter. It's an excellent question, because again, I think it reveals a prejudice and a common misperception, and I think again I'm doing nothing but relaying the wisdom of Jeff Snyder, that gold may well be accelerating to the upside, owing to the acceleration in deflationary pressures within the economy. I think the British economy in the first half of the year contracted by an incredible 20% year over year. The US is not going to be as dramatic as that, but still it's going to be, it feels like, what is it going to be? It's going to be kind of double digit, kind of 10%, 9-10% down. That is deflationary. And, you know, the Dawn of Chaos paper that I wrote was saying that inflation is, it's not that it's not a monetary phenomenon, because it's a truism. Of course, it involves money, but to initiate it, then it requires a change in psychology. And it was always hard to see the change in psychology, but with the virus, with the V, it's kind of turning our society inwards and one against the other. And these are kind of these are the first stepping stones for the change in psychology, which could then make inflation a monetary phenomenon. Because, you know, planes are traveling with no one in them. You know, we're kind of banning people from traveling again. It's getting harder and harder to go into shops. Commerce is very difficult. Now, whilst the expectations or the mindset of people, to my mind, the mindset of people is going to get angry or more frustrated one against the other. But maybe that's still brewing. But the clear and present danger just now is the economy is going to go. It's going to go south again. It's really not going to recover with any vigor. So, having a large cash balance, if gold's going up because of the deflationary force, then having a large cash balance is a good thing. If gold's going up because that kind of febrile world of expectations and psychology is slowly but surely now turning, and people are getting angry, and we're all going to fight each other. I mean, I despise being told to wear a damn mask. It's stupid. You give me the data. Why are they not telling us the data? The data is, it would seem that this is a kind of nasty influenza, but no one dares tell you that. So, you know, there's me, and I'm trying to be a kind of rational person, but I'm angry. And I get angry watching people wearing masks. So that's the kind of us against them. And these are the initial steps that have to be taken if you're going to start talking about the kind of hyperinflation. So we're not there yet just now. So your chart with the high cash balance, I think the best thing I can say is that the question reveals a kind of a worry note that they don't know. I've got this high cash balance and I don't know. Okay, and I understand that uncertainty, but my guiding principle, a bit like you were saying, you have your portfolio and you have your rules and they work for you, is that when I reach a juncture where I'm just not sure, but I feel kind of trapped because the one thing I have in this instance, I've only got a cash balance. I've got a very high cash balance, and that may be a good thing, but it may be a really bad thing. So, like the French Foreign Legion, my motto was always like advance, do something. Don't get stuck in the headlamps, if you will. And so with the high cash balance, I would propose in this instance to take 1/3 of that cash balance and invest it. And you've done something. So in 2-3 months' time, in 12 months' time, you can review it and you can say, oh my God, that was the dumbest thing I could have done. But thank goodness I only used 1/3 of my assets. Or you might say, thank goodness I did that because that was the right thing to do, and at least I started, and so it gets easier at each turn to get that money invested. So it's difficult, but good luck.
Yeah, Hugh, why would more social unrest or people becoming more tribal with the masks and the story that you just told about your personal experience, why would that take us closer to inflation?
It takes us closer because all of the monetary and economic statistics that you do a brilliant job with your whiteboard in explaining. The reality is they don't. Everything they teach us in business school and economics kind of has been disproven over the last 20 years. It's kind of why the global macro hedge fund sector really has struggled to make money. All of our textbooks have proven to be redundant in this kind of atmosphere. So as an example, Weimar, the German economy, suffered hyperinflation after the First World War. But it wasn't set in stone. And before the prices took off, their data looked tame in comparison to the government finance data that we're producing in the US today. I think at its peak, the German government ran a 12% budget deficit. And I think this year the US is on track to be, I think, 2 times that. So that's your kind of the government's spending more and more, and it's requiring the central bank to print money. Well, in Weimar, so today the US government is spending more and more money, and the Federal Reserve is kind of financing it via quantitative easing. And I'm saying that the quantum is 2x what it was back in Germany. But what what created the hyperinflation, I believe, was that clearly Germany had suffered defeat. Clearly Germany was a nation divided between those in favor of the kind of, the Kaiser and the old way, and then those who wanted republic. There was military. There was many, many divisions from religion to geography, if you will. And then you had the victorious allies imposing this demand that Germany transfer really the majority of its gold reserves to the victors, if you will. And that really got people angry, and they started killing. They started killing politicians. So you had death squads. Japan had hyperinflation in the 1930s, and it was the same thing. The central bank governor of Japan was assassinated by the military because he started pulling back, feeding the easy monetary policy. And so and you think of all the episodes in South America, and you think of it in places like Zimbabwe. It's when it becomes tribal and society turns upon itself, and you get anarchy and chaos. That's when you get inflation. We're not there yet. We don't. The situation is kind of bleak versus the kind of perfectionist bubble that we've lived in for the last 100 years. But it's not anarchy yet, and that's the unfortunate step.
And is it because the result of anarchy is there's fewer goods and services that are being created, and therefore there's more currency units that are chasing fewer goods and services, while at the same time the government is trying to subdue the anarchy through some sort of transfer mechanism or printing money to give to the individuals to calm them down? Or you see where I'm going? Like why does anarchy lead to inflation?
Yeah, I think it's just the complete utter breakdown of normal rules for society. You don't trust anything.
So then you don't trust the money, so you spend it and get commodities or anything that you can trade, or okay.
Yeah, it's like people trust treasuries today.
Yeah,
and
right.
I know that's a very contentious thing to say, but you know that if you buy a treasury, you can sell it. You can either sell it to another market participant, or you'll be able to sell it to the Federal Reserve, and there's a kind of security, if you will, in that knowledge,
Right.
and it's that security and knowledge. It's that security and understanding what the next step is. If I do A, then it results in B, and everyone kind of agrees on that. Where the anarchy that I'm talking about is you buy a treasury and you've no idea whether you'll be able to sell it. So it's those little subtle changes, which, but it's subtlety rather than.
That's some great insight. Great insight for sure. Okay, let's see. And guys, just as a reminder, if you want to submit a question, just make sure you start with the word question and in capital letters so I can see it. Okay, so Taylor asked, do we retest the March lows? Will a wave of defaults lead to a similar crash in Q3, Q4 and force a second stimulus of the same or greater magnitude? I think, Taylor, I to answer your first question, I'd try to think through the last question, because, and I'm not saying there's a causal relationship here, but what I am saying is going back to March, when the Fed came out and said that they were going to do QE infinity, when they were saying they're going to commit $1 trillion a day to the repo market, if that's what it took, when they were creating all these and reinstituting some of these 4- and 5-letter bailout programs, alphabet soup is what everyone calls them, the market still was going down fast. The market almost didn't care. So it's like the quote unquote Fed put kind of expired. But you'll notice, going back to March, that when the government came in and announced that they would do this stimulus package and they'd commit to a lot of fiscal spending, then the market turned around. And again, I'm not saying there's a causal relationship with it, but I am saying it's interesting. And therefore, if going into Q3, Q4, if you believe that the government is going to come out with a giant stimulus package, whether that's by spending the amount of money that's in the TGA, and personally, I think that's what's most likely. They've got a 1.7 trillion in the TGA right now, already earmarked to spend. So that increases bank reserves. That's like quantitative easing, and that's increasing M2 money supply directly. So, if they do spend, let's say, $1 trillion in a 2-month period, then what are the chances that the market goes down? Because right now the market, in my opinion, really isn't tied to any fundamentals. The market is just tied to movement of liquidity or expectations of future liquidity coming into the market. So I think if you're someone that believes we're going to get that stimulus, then I don't know that we retest the March lows. If you're someone that believes that we can't get the stimulus because of like a political gridlock, such as my buddy Eric Townsend, then maybe those March lows are more likely. Hugh, what do you think, buddy?
I'm constantly surprised, but I would be surprised if we were to touch those March lows this year. More likely, I think the nature of the explosive move after those lows. In my head, I'm thinking of the period between 1998 and late 1999, the blow off in the TMT stock market. And we're seeing a lot of signs similar to it when you look at share prices of Tesla and some of the FANGs. And the typical footprint is that they rally from lows. So like if we take the March lows as the start of this process, they typically go up 200%, then they half, and then they go up 200%. Then you get this kind of sawtooth, very violent progression.
Right.
And I think if they decide to do another $1 trillion in terms of stimulus, I think it's largely irrelevant. I mean, they've committed to doing $2 trillion, and the $2 trillion by and large looks like a waste of time. Now, if they were to turn around and say we want to spend $5 trillion and we're going to do it on infrastructure, because if you go back to Professor Richard Werner and his notion that you can basically print unlimited quantities of money if it's going in to finance productive investments which are going to expand and deepen the productive capacity of the US economy. Spend as much as you want. And one of the great mysteries is why America, this AAA nation, is sitting there with triple C infrastructure. Why the politics can't be sorted out to justify improvements in rail, in airports, in linking airports to city centres. I mean, you could easily spend $5 trillion, and I'd be very comfortable that you're making the US economy deeper and more productive. But so unfortunately, I don't think we're going to see any of that. When you mentioned third and fourth quarter, the big elephant is the election.
Sure.
The risk markets get that. The spot volatility has not come down to the kind of 10, 12 level where you would expect it to reside after having seen stocks recover so emphatically. It's still trading kind of north of 20, and that's because people are very concerned about. I think they're most concerned about Trump losing and losing kind of poorly and kind of creating some constitutional crisis. The fact that you can even say constitutional crisis in reference to the impending US election is food for thought. And so
yeah. What do you think about if Biden wins and an increase in corporate taxes? Does that feed down into the valuations, the PE ratios, and therefore the market, or is that kind of, it just doesn't matter because there's so much liquidity? It goes back to the liquidity question.
Well, no one pays corporation tax, or the very large companies don't pay it.
Right.
What is the corporation tax? Think of the top 100 companies in America and their average corporation tax. I mean, I don't know the answer to that, but I would imagine it's very, very little. I would imagine it's kind of like 15%. The other thing is that I still push back on the notion that the stock market is crazy expensive. It's gone up a lot, but there are two factors that you have to kind of understand which are at work. First of all, it is, for all the talk of gold going up, it is still a profoundly disinflationary environment, and it could tip over into a very deflationary environment. It's a word to repeat myself, but the US economy is going to contract by about 10 or 12% this year. So running a business has become riskier. If you are operating a chain of restaurants or airlines, or you're operating cruises, etc., business has become profoundly damn risky. Okay, and so we have a thing called the equity risk premium, which is kind of a handicap system, and so it's been pushing down valuations on a lot of businesses in the stock market. Those are businesses which have become riskier with the cloud of disinflation and the virus impact. On the other hand, there are businesses which kind of, on a relative basis, seem to be immune from those risks. Some pharmaceutical companies, some businesses like Nestle, and indeed, of course, things like Netflix and Amazon, and these models which have been tested with the destruction of the virus, and yet they've expanded their profits. So for those companies, the risk premium kind of is not interfering. And so what's happening there is the other factor, the factor that the risk-free rate, the 10-year treasury rate is 50 basis points. So the value of money in the future, the value of future profitability just now is being discounted at a very, very high and valid discount factor. The discount factor is almost zero, which is to say that the valuation is very high, but that there's nothing funky or out of sync. That's kind of nature, and that's a kind of natural equilibrium. And so FANGs and some risk, if you can operate a kind of a cash generating business which has gone through this year with profits uninterrupted and profits up, I kind of want to suggest to you that that is almost a priceless business. There's not a limit on what people would want to pay for that security today. So you have those businesses represented in the stock market, and then you have all the others, and all the others kind of are lowly rated. They're kind of probably on about 14 times normalized earnings, which is kind of where they trade all the time. So you've got the majority of stocks stuck on this kind of boring valuation, and then you've got a tiny subsector of stocks which are almost priceless and kind of influence the overall valuation. I think stocks have kind of got it all. Like, I don't think they're crazy.
Yeah, especially when the market cap of those that are going up is so high.
Yeah.
And when you look at just the broad S&P, I think what a lot of people are looking at in the United States is that they're just walking down the main street of their town, and they're seeing that 50% of the shops are closed. I mean, I'm here with you, obviously, in St. Bart's, and you and I walk down the main street of St. Bart's, and pretty much everything is open. They might have a little different hours or something like that, but pretty much everything's open. It is not like that in the United States. I mean, imagine walking down, right by where we eat at Victoria or something like that, and just literally 50% of the shops are boarded up. And, with signs just saying, we don't know when we're going to open, wear a mask type thing. And then so then the average American is seeing that. And then they're looking at the marketing higher. And then in addition to that, they're seeing companies like Hertz that are filing for bankruptcy, while at the same time, their share price is going through the roof. Or Chesapeake, something like that. Or then they look at Tesla, where it's just going completely parabolic, regardless of the fact that I don't think they've turned an annual profit ever. And so I think that's the balancing act, and that's why. I mean, I totally get what you're saying, but I think that question pertains to them just what I was saying, walking down the street, seeing with their own eyes, and then seeing kind of the insanity that we're having in the market right now, as far as some participants doing things that just don't make any sense whatsoever. And you see what I'm saying?
I do, but so the proposition is you can buy a retail stock, the Gap, let's say. I don't know the valuation of the Gap. I imagine the Gap today.
If they're still in business, Hughes.
Say again?
If they're still in business, they might have gone bust. There was it might not have been the Gap, but it was one of the retailers just like that. It's already gone bust.
Yeah, well, there you go. So the question is, is paying 8 times earnings, is that a good deal for buying a retailer? Okay,
right.
When half when it may go bust, or is paying kind of 40 times for Amazon, is that crazy when it's not going to go bust and its profits are going to be higher next year?
Right.
And yet people see, because of course Amazon has a $1 trillion market cap, and so it has a big influence on the overall markets.
Yeah.
Which is the crazy. I kind of think maybe paying 8 times for the retailer, which has a 50-50 chance of going bust if they close the economy down, I think that's crazier than paying 40 times Amazon. And I'm making these numbers up a little bit, but that's kind of the debate which is being processed by market participants today.
Yeah, I think you got to look at the individual company for sure. And I know from what I've heard, I haven't heard an interview with Druckenmiller lately, but the last interviews I've heard with him, he was saying pretty much the exact same thing.
Good old Stan.
Yeah. All right, let's try to find another question here. Oh, here we go. Here's one for Hugh directly. It says, Hugh, what is your thought on dang it. It moves around on me so much. Here we go. Hugh, what is your thought on buying Russian treasury bonds or the equivalent? And how does one go about purchasing foreign bonds, foreign government bonds?
I think someone's setting me up. Did you say Russian treasury bonds?
Yeah. I think
You cannot be serious. I would never buy Russian treasury bonds.
Tell us what, because I think they're watching Jim Rogers, because Jim Rogers is stated on record, I think maybe a month ago, that he bought quite a bit. So I think that's where they're going with it.
Good luck to Jim. I have these ongoing Twitter fights with Luke Groman, who seems to be, I think he's sponsored by Russia and China. I'm like, you love it so much, go and live there, go and live under a fascist regime. I mean, Trump's bad enough, but can you imagine, like, they've got Vladimir Putin for life, and they've got Xi in China for life. I mean, hallelujah for liberal social democracies. US Treasury bonds are freedom bonds. Okay, it's a little bit like back in the 70s or 80s, 80s, I think, Pepsi had a very, very successful advertising campaign where it asked you to do a blind test. And in blind testing tests, scientifically, without a doubt, people prefer Pepsi to Coca-Cola. Except Coca-Cola represents freedom. It represents the majesty of everything American. It represents the kind of youth and the wonders of being in California. It represents the movement to when we had the Doors, and then suddenly on the music group, the Doors, and suddenly you could listen to music in stereo and it's beep, beep, beep. It represents everything that's wonderful about life. It's captured there. And treasury bonds are kind of the same to the rest of the world.
They've got a brand.
Yeah, well, billions of people up until 25 years ago either lived behind an iron curtain or lived, were oppressed. And people would smuggle in kind of Coca-Cola, rock music and stuff like that.
Levi's.
These are the Levi's. Yeah. So the chance for them to invest in treasuries, yes, never been subject to confiscation. I was having a debate that, hey, why is it that in this kind of fascist regime in Russia that there's a zero capital gains tax on your gold holdings? And I'm like, because it's Russia. It's the last place in the world. Let Jimmy can, I don't care. Like, Jimmy can go and, like, have fun with his Russian hosts. But, even I would rather pay, what is capital gains tax in the US?
Long-term cap gain, well, I think it's about 20% right now.
Okay, cheap. I would easily, I'm happy paying 20% to own gold shares, gold bars in the US, rather than like to save on the 20 and have it sit in a Russian bank vault in Moscow. Years. So no. Anyway, holding foreign government bonds is really all about participating in the currency. You're anticipating that the currency of the host government, be it Russia, China, be it Thailand, be it Europe, you're speculating that the currency will appreciate vis-a-vis the dollar. But you don't have to own, certificates of confiscation in fascist countries. You can achieve that by opening a bank account and transferring money into having like a yen deposit account for the major money center banks. I think can organize those things. It's complicated, but it can be done without having to buy, God forbid, buy Russian government bonds.
All right. Let's do one more question. Oh, here's a good one for Hugh. So I don't know if you're aware, Hugh, but Buffett just bought a bunch of Barrick Gold.
Yeah.
So what are your thoughts on that? Is that meaningless, or is that some sort of signal we should pay attention to?
Yeah, they're always signals, but the biggest signal would be given the size of his portfolio, where there, at some point this year, if he towards the end of the year, if he was to reveal that he had or his representatives had moved to allocate, let's say, 10% of the entire portfolio towards gold. If it's just one gold stock in the context of 50, 60 others, and it's a kind of 1% of the overall portfolio, big deal. I think at the same time, he had been cutting back on his bank shares, and that's kind of
right.
that may be related. It may not be, but so far, it's always interesting. There are papers from the Berkshire Hathaway meetings in the late 1970s where Buffett does kind of come across as being more than cognizant of the kind of speculative charms of gold. But it was getting so late in that bull market, that 70s bull market for precious metals, that I don't think he really pursued it. His opportunity really came from loading up on, superb American businesses really at the bottom, with 10-year treasuries yielding 12%. And so stocks probably on 5-6 times earnings. And that was the big generational shift that he got back then. But when he was doing that, preparing to load up on all these kind of generic American companies, he was very, very cognizant of the powers that are perhaps unfolding today in the gold market. But like I say, at this point, who cares? But if he comes through in the following quarters and is going up and going up, then it's the real deal.
Okay. So last question. Let's go back to our debate at the beginning of the live stream. And because the question I should have asked is, we might see the sale of gold a little bit differently, and that's fine. But what would get you to sell gold? Because you're bullish. So do you look at the charts? Do you look at psychology? Or what? I mean, what would make you go from being bullish gold to say, okay, it's run up way too much, I'm now a seller instead of a buyer?
Yeah, well, for sure. I think it more pertains to the gold equities and to silver, and it's just again, I always go back to this. It's the kind of biblical story of Jesus and his disciples, and these guys are like, they found the ultimate gold trade. They're hanging out with the Almighty, and he's saying, and they're convinced, it's like, you are the man, and he's like, before the night's over, you will have rejected everything that you've just said, and it's impossible. And so the kind of nugget, if it is a nugget of wisdom that I would leave on, is that markets are all about making you reject what you believe passionately today. I put out, I think a week ago, I put out this kind of short, very, very short video saying that markets use volatility to separate profits, from professionals and ordinary people. And remember, gold shares have a volatility, so that the daily price movements, it's as high as 50 or 60%. So that is like 5 or 6 times greater than the daily volatility of the S&P stock market last year, which is to say that, again, they can go up 200%, and that's kind of fun, and that makes you kind of feel emboldened. But then out of the blue, they'll half, and that kind of gets you close to saying, Jesus? Well, the guy with the beard, never heard of him, never saw him, no idea who you're talking about. So markets, and indeed my whole thesis about if inflation is going to become a reality, and it's very much just now an imagined reality. I know, people say, oh, shut up, Hugh, because, have you seen my healthcare costs? Have you seen education costs? Have you seen this and that? For sure we've got inflation. But I would come back to the people who say that as their retort. And I would say, listen, these guys have put out this kind of benchmark, 2%. They have said that they will judge themselves as being effective and doing a good, diligent job as central banks if they can get the average level of consumer price inflation to 2%. Okay. And that's not a big hurdle. And as we know, there is the capacity to cheat, if you will. Like you can change definitions. So can you imagine, like, you've got all these vested stock options, and the one thing you've got to do is generate 2% inflation. You would find a means of achieving that. Yeah. And yet since 2014, it has been a catastrophe. It keeps the rate of official price inflation keeps ratcheting lower and lower. And that, and like I say, that's from guys who could cheat. You know, they could kind of, twist the dials. So disinflation just now is the kind of reality. Anyway, that rant over. Anyway, good old Jesus.
That's a great point, and it goes back to the conversation that I heard with Lacey Hunt, and I think we actually talked about this over dinner briefly the other night, and it was just such a fascinating interview, and to hear Dr. Hunt outline his argument for disinflation, which I think is what you're talking about, this gradual disinflation where the inflation rate goes lower and lower and lower. You look at a trend line, and then going into potentially deflation. But then he saw that there could be a trigger, there could be a catalyst to where his opinion would change, and then defining, okay, what is that? Where's the line in the sand? And for him, it was the way, in his words, he said it's when the Federal Reserve, when the bank reserves turn into legal tender. So the bank reserves, the Fed can print, when those turn into legal tender, and he said that when the Fed starts paying the bills directly, he said that when he would move from a disinflationary stance to something where he would see inflation being a much higher probability, even going into some substantial inflation. He even used the term hyperinflation.
Yeah, well, he's obviously someone we all admire. That description is very technocratic. I don't even fully comprehend what he's talking about.
What he's talking about is right now the transfer mechanism for the bank reserve. Let's say they print a quadrillion bank reserves. Let's say that there was enough assets where they could do that, or somehow, to your point, that it's been ruled, they make it work, right? Well, if those are just bank reserves, then it doesn't necessarily mean that the CPI increases, because broad money that's chasing those goods and services might not increase. Now, if they use all quadrillion to monetize government debt and they spent that into the economy, then yes, you would have more currency units chasing goods and services, or fewer goods and services. But generally, if you're not monetizing the debt, then the transfer mechanism, take broad money supply, base money supply, and the broad money supply would be the banking system. And it goes back to your original point. There's got to be a psychological component. There's got to be a psychological shift to incentivize the banks to create more loans, and therefore people to take out more loans. And then you've got, because all base money does is increase the balance sheet capacity of the banks to lend. That's really all it does. And a lot of people that might not fully understand the system, they a lot of kind of average people out there, they just see the Fed, quote unquote, printing money and creating this base money, and assume that that's legal tender, that just gets right at some point in time, that'll get out into the system. But that's not necessarily true. So so I think if Dr. Hunt's point was that if they abide by the Federal Reserve Act, because the Federal Reserve Act doesn't allow them to spend money directly into the economy, them meaning the Federal Reserve. If they abide by those rules, then he's on the disinflation side. But if they amend the Federal Reserve Act to allow them to turn bank reserves into legal tender, then he goes over to not just the inflation camp, but the hyperinflation camp. And those are his words, not mine. So I think that's how he's defining those.
I would, with respect, but still reject that, because it comes back again to the expectation. So you did very well. You put me on the spot earlier with the, explain why it's expectations that make the difference and are truly the catalyst for entering into inflationary or hyperinflationary environment. And because you always insist on feeding me tequila late at night, and then we have these things on Sunday mornings, my mind doesn't work on Sunday mornings. I kind of went blah, 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 blah. But the reality is, it's expectations which lie behind, this velocity of circulation, which is kind of trending to zero. And could go, why can't it go negative? It's expectation. So my fear about what Lacey's talking about, this technocratic change, kind of who cares? Because to generate that shift, it's people have to be willing to borrow the money, or the banks have to be willing to lend the money. So the Federal Reserve has tried as much as possible to facilitate, to encourage the banks to be more generous in credit provision, and it's also tried to encourage a very kind of risk-taking behavior on the part of US citizens, so that both demand and supply of credit would increase. And that has been a failure, because I think expectations presently are formed by deflationary fears. And so banks don't want to extend the credit because they fear that the credit will not be repaid. And borrowers don't want the money because, like you say, you walk down the high street and half of it's boarded up. You go on a plane and there's like you and 5 other intrepid souls. No one's got an appetite. So it's how we change that appetite. And when I was having fun 6 weeks ago, whatever, I was saying, put Joe Rogan, like put me in charge of the Federal Reserve. That would change expectations. People would go, holy shit, really? We've got this crazy guy. we're going to have inflation. So if I can borrow today at like, what's the 30-year borrowing rate today in the States? I imagine it's like around about 2% or something.
For what type of debt?
For buying a property.
Oh, I think it's around 3.
3. Okay, 3. Be like, wow, let's do that. I want to, this thing's gonna double in price. I want to buy it. I want to buy it, and I want to finance it with your crazy fixed paper, which is going to be meaningless. This is the greatest deal ever. But people don't feel that just now. So the change in expectations, we've got to shift people from fear to greed. And greed presently is fear. Fear is everywhere. Fear is the number one thing driving this stupid mask. Is this insane fear which doesn't even have data to validate it. So it's fear. And if we get greed instead, we will get inflation. But regardless, gold is, and because people just want to hear about gold, and gold is a great instrument when fear is in the atmosphere. But just now, don't confuse yourself. You don't need inflation for gold to go higher just now. It's this fear, this fear and the anarchy of fear just now. But it's the anarchy of greed which would really upset and change the equation.
Yeah. So let me just ask you one more quick question here, because this is what I've thought about a lot. And, you and I were looking at real estate here in St. Bart's a week ago or whatever it was. And a lot of the conversation that you were having with the real estate agent was revolved around regulation. Yeah. Because they have this regulation. We were talking about how hard it is to get something licensed and, paying all these fees, and it might work out, it might not work out. So as a former entrepreneur myself, maybe I'm a current entrepreneur, it's debatable, but I always thought that the more regulations that were out there, the harder it was for me to do business. And if what you're talking about is basically animal spirits have to increase in order for the demand side of the equation to increase, meaning the appetite for new additional loans that would increase the money supply and get that velocity going. If that's being hampered by additional regulation and ever increasing amount of regulation, does that play into those animal spirits? Does it have enough of an effect on the animal spirits to where it could reduce the future expectations of inflation?
Yeah, for sure. So we're talking about inertia. People are not taking on more risk. So they're kind of either happy or sated at the present level.
Right.
And so you're trying to get them to step over the line. But the more that you have, silly regulation or things which create more uncertainty is risk. So regulatory uncertainty is something which makes it riskier. So the people are looking at the world today, like I said, the average stock is really on quite a modest price earnings ratio. Okay. And it's assuming that profits will normalize kind of soon, that the virus was an aberration. Regulation just messes that up. But in the context of the discussion we were having in St. Bart's, the regulation certainly makes me think twice, because it makes it really hard for me to want to commit $10-15 million in capital when they're kind of changing rules. However, the other thing that they're instigating makes it feel a little bit, I hesitate to say the word Bitcoin, but there's a kind of reverse supply engineering thing where I think it's just happenstance, but they are determined to reduce the supply of property on this tiny island, which is besotted by people, billionaires fight over trying to get a plot of land, and they're actually making it harder to build more, and so that makes it more precious. And I say that in the context, we've just had a transaction recorded in the last 2 months for about $65 million for a beachside property, which is kind of property values you see in Malibu. So you can see there's still, even with the world today and all of the problems, there's still someone prepared to put 65 million buying a beachside property in St. Bart's in this environment.
Right. So that just goes to show you how there's always these cross currents.
Yeah.
That we have to consider. That's for sure. Hey, just out of curiosity, what are you doing as far as St. Bart's real estate right now? I know we've always talked about it being kind of a way to go long volatility. And since I've been on the island, I know you've been kind of thinking that through. You've always been a big fan, for obvious reasons, of real estate here. But looking at it from a macro standpoint of a way to go long volatility, what are your thoughts on that? And I know you've been exploring that more on Twitter. So, guys, if you're interested in understanding Hugh's thoughts more on how he sees real estate here in St. Bart's, make sure that you follow him on Twitter and mention him or something like that if you're interested in finding out more, because when I got here, I'd never been to St. Bart's, but the more I'm here, the more I experience, go out to restaurants, the downtown area, and see exactly what you're talking about. It makes a lot of sense as to why long term, that if you were someone with means, you had resources, and if we get the social unrest increasing in the developed economy, if someone like me or someone like you or any of these other people that are coming here, it's a very attractive proposal. One more thing also is a lot of the social events I've been here or I've been to here in St. Bart's, a lot of the people are Americans who are coming here for the exact same reason. And a lot of these people, they're from LA, they're from New York, they're from Miami, and they're coming here permanently because they're sick and tired of what's going on in the United States or their state in particular, and they're bringing their resources here to a place that's got limited capacity, to say the least. So anyway, what are you doing on that side of it, and how can people maybe find out more and to hear your thoughts on going long volatility, and more specifically through the real estate here?
So personally, for me just now, I think I'm a microcosm for all of the kind of disinflationary inertia or trap that we're in just now, because it's I have a great ambition to do more, but I'm kind of ultra cautious at the present time. I'm being kind of dragged down by the very complex and boring, and sometimes it seems irrational kind of building code, which is, I'm trying to build out another property at considerable expense. At the same time, reinvesting in existing properties. But at the same time, I'm kind of having to deal with the fear that we get another lockdown over the winter period. Now, the St. Bart's model, the high season in terms of the high room rate season begins towards the end of December and runs to the end of March.
Right.
And so it's very, very susceptible to having another lockdown. But, I'm persevering, and also I'm kind of, at some point I may present myself in terms of, I've got an unfair advantage. I'm a kind of smart guy on this sleepy island, and I know it inside out. I built beautiful houses, and we rent these houses. They're amongst the most successful rental properties on the island. And I have a kind of maybe a secret ambition, which is, I can take people, we can find and we can build them similar properties, and then my idea is to brand it and to have a kind of a commonality, kind of like Soho House. It's one thing to have a beautiful house. It's another thing to have a beautiful, but a house which resonates with a cool lifestyle. People will pay anything to be cool, if you will, and that's something I'm investigating. And then lastly, I think one of the relevant points that we raised in our conversation yesterday was just the new attraction for some of these other Caribbean islands, not to live there, but to secure another passport. I think we were talking about St. Kitts. St. Kitts is a little bit expensive, but what was the other island? St. Lucia?
Yeah.
Where with one passport, you could be American and traveling to Europe. If there are people with a particular level of income that can buy these passports, and therefore find themselves with a license to roam again and to exert the freedoms that we took for granted only 3 or 4 months ago.
Yeah, exactly. Well, Hugh is really the way I operate in Medellin, as far as that level of expertise I have. That's exactly how Hugh is here. And everyone always talks about, or hears me talk about, getting a 1% RV ratio. And what's staggering is on some of these properties are so expensive, and you can still get a 1% RV ratio on some of them, just like $100,000 rental in Kansas City, Missouri. It's crazy. But anyway, guys, if you're interested in knowing more about that, it was fascinating to me. Definitely follow Hugh on Twitter, and maybe mention him if you got a specific question or something like that. All right, Hugh, we've gone long. I want to thank everyone for hanging out. Guys, if you're thinking about investing or what to do with commodities or buying things cheap or gold or these miners, definitely check out Rebel Capitalist Pro. My partners Lynn Alden and Chris McIntosh. It's that online forum we have. It's at georgegammon.com/pro. I want to thank a lot of people for staying here to the end. We had over 1,100 people online today, and a lot of them are over 1,000 are still here. So Matt, thank you very much for staying till the end. We have NTC Broadcasting, Movie Hipster, Justin, Glenn, Call for Truth. Let's see who else we have here. Fat Vegan, Hank, Monica, Total Recall, SAS Crypto, Eric, Donald, thank you very much. Let's see who else we have. Eric, Gerald, Arthur. Arthur's always here. Thanks, Arthur, for hanging out again. I appreciate it. I'll see you, Arthur. I know he's a Rebel Capitalist Pro member. We'll see you in about 45 minutes on my live stream. Anthony, Jim. All right, guys. Appreciate it. And I will see you on the next video.
Thanks, guys.